Hi, everyone. Thanks for joining us for BlackPoint Capital's July market recap. I'm Nicholas Mauricio, managing partner here at the firm. And we've had a data-packed month, and today I'll walk you through some of the key highlights before bringing in our outsourced Chief Investment Officer Arun Kaul to unpack what it means for your portfolios. For today, here's a quick snapshot of what happened in July. Fed held interest rates steady again, but two dissenters emerged in the first real sign of internal disagreement. Futures markets are now pricing in a 99% chance of one cut by December. And on the yield curve, 1-year treasuries are yielding 3.92% and 2 years at 3.74%. While GDP is rebounding to 3% after a tariff distorted negative 0.5% in Q1. We also saw the rise of a couple of new deals with Japan, EU, and Indonesia. And lastly, we'll finish off with the S&P 500 trading at a 22 forward earnings and equity risk premium collapsing over the rest of the year. Now, moving on to Federal Reserve rate outlook for September. Arun, on to you. Could you give us a little bit of background as to where we're at for September and so what we see moving forward into the rest of the year for rate cuts?
Yes, so the most recent inflation data the last 4 or 5, 6 months have actually been on target. So we have seen lower inflation in the last short-term period, but the 1-year number is still a little bit elevated above the Fed's target, but the trend is definitely toward target. And of course, we've seen significant pressure from the administration on the Federal Reserve to cut rates. So right now, it looks like we have an 80 to 90% chance of 2 cuts before the end of the year to the federal funds rate.
Okay, and how do we, they're pricing in this before the end of the year. How do we interpret this versus policy signals, or is it market pricing?
So this is largely where the market thinks rates should go. The Federal Reserve has been quite reticent to lower rates ahead of what they think will be more pressure from tariffs. But if you bring in some of the job activity, the jobs numbers were lower in the last report, and there was a significant reset of the prior numbers to significantly lower figures as well. So the job market might be much weaker than we initially thought. So if you have lower inflation and weaker job numbers, that's enough on the policy side for the Fed to start to lower rates.
Okay. And so then moving on then to treasury yields and some of the trends that we're seeing into the back half of the year, the short-term yields have come down relatively quickly for both the 1 and the 2 year. Could you walk us through this chart here? And do we see this as the bond market potentially front running some of the policy, or is this maybe some genuine concern about slowing growth moving forward?
So certainly the 1 and the 2 year rate from the bond market, which the Fed does not directly control and are not set by the Fed, is a very good indication of where rates are going if we look forward. And so both the 1 year and the 2 year are below 4. They're around 3.7, 3.9, which effectively is the same as 2 rate cuts. So that's a good indicator of where we are going. And right now that's predicated probably more on inflation than it is on necessarily focus on growth.
Okay, and so this begs the question then, who's right? Is it the Fed? Is it the futures markets? What are your thoughts on that?
So we definitely have issues with the employment survey at the Federal Reserve, where the response rates are down to 50 and 60%. And as well with inflation, there are now better metrics available where independent data gatherers through new technology and AI are able to gather millions and millions of data points. So I think the market probably has better information and faster information than some of the government agencies. So I would be prone to follow the market numbers more so than some of the Fed models and some of the government agency data.
Okay, so back to the old adage, the markets are usually right, and they price most of this. And moving on then to GDP, which was the hot topic of basically the first half of 2025. In Q2, we did get a strong GDP print of about 3% after that falling negative 0.5% in Q1. Much of Q1's weakness was driven by import activity or ahead of tariffs, essentially. Does this Q2 rebound feel durable to you? And if so, are these new trade deals with Japan, EU, Indonesia economically meaningful, or are they just noise at this point in time?
I think the trade deals are quite substantive. They're obviously very favorable for the US. It's unclear on exactly some of the policy details, but the general trend is 100% in one direction, and that is in favor of the US, investment in the US, access to capital for the US, directly in some cases from governments that will agree to invest in the US based on objectives or parameters of the administration. And the US is collecting a 15% tariff. So how this all plays out obviously remains to be seen, but the direction is definitely favorable. I would say that on the GDP print, the two quarters together are not that strong. So Q1 was certainly distorted. -5% was from imports last quarter. So that did not happen this quarter, but the reset may not be quite as large as one would have hoped given the negative number in Q1. But overall, if you look at the policies of the government, they're largely pro-growth. The regulatory agenda or the deregulatory agenda is significantly pro-growth. And the administration just announced a significant reworking of EPA legislation in which there were some pretty substantive and onerous regulations on energy and energy mandates that they look like they're going to roll back as well. So overall, very pro-growth policies from the administration.
Okay, that's good to hear. Pro growth, I think, is what everybody's looking for, and that brings me on to the last slide here is S&P 500. Some of the equity valuation and risk premium. S&P 500 forward PE is up to 22 times, and equity risk premium is basically erased, just 30 basis points over the 10-year. How do we view this equity risk and this kind of a valuation environment right now?
So it's definitely a trickier backdrop. We have very high multiples on the S&P. They're just slightly below the all-time highs of 1999. And we have rates on the 10-year that are over 4%. So there's very, very little equity risk premium available to equity investors. And on top of that, you have a pretty significant skew in the market to a handful of very, very large names. NVIDIA now over $4 trillion of market cap. So you've got the Mag 7 that have largely been responsible for the excess returns. And if you look at the S&P 490 to the 493, those returns have not been as strong as the Mag 7 numbers. So I think we're in more of a stock picking market going forward. I think premiums and valuations are high. And I think investors definitely want to be careful how they're designing their portfolio and constructing some of their equity exposures going forward.
Okay, and so you mentioned the portfolios. How do we make sure that we're positioned within our current strategies to take advantage of this moving forward?
So a couple of items, definitely want to look at the underlying exposure to those large names, the Mag 7, the tech names that are a larger share of some of the holdings. So separating some of the ETF holdings and some of the index holdings based on their concentration. And started looking at some of the individual stock picks in terms of replicating concentration if you have duplicate names that are large cap weighted in some of the holdings. So I think investors really want to disaggregate some of the weightings for the large names and decide how much exposure they want. Those firms are still quite strong in terms of their overall market positioning, their margins, and their earnings growth, which is in part why you're seeing such high multiples. And of course, they're also at the forefront of new technology, primarily AI, and the development of applications related to AI and obviously data warehousing and storage of data. So the exposure makes sense, but it's definitely expensive, and it's probably difficult to say how much further the multiple can expand from here. It's unlikely the multiple can expand a lot further, which still probably means you're going to get lower returns from those large Mag 7 names going forward.
Okay, perfect. And thank you so much for that, Arun. For then, so some of the key takeaways and what we're watching for closely into the back half of 2025. So rate cuts are likely, but the market may be too optimistic for multiple rate cuts moving forward. T-bills or Treasury bills are still compelling at this point in time, but yields are falling. And so that may be something that we're keeping an eye on a little bit more closely. And growth is still resilient within the economy as a whole, but it is driven a lot by policy distortions. And lastly, equities are expensive. So this is a point in time where it does make sense for us to stay selective and make sure that we're thinking strategically across the board. And valuation discipline is going to be critical when working with your advisors on all of the portfolios. And that's it for today, everybody. If you'd like to understand how this impacts your portfolio or positioning, feel free to reach out to your advisor or the info@blackpointcp.com mailbox. And thank you very much for spending some time today.